Hey, it's Tom here and welcome back to the channel. So in this video I want to basically give my 2 cents on the ongoing debate that is Berkshire Hathaway versus the S&P 500 and which one is likely to give the best returns moving forward. And there's people on both sides of this argument and I want to, like I say, basically give my thoughts on it and try to use as much sort of quantitative data behind this whole discussion as possible. There's a lot of different opinions on both sides of the coin, and a lot of people try and go to the Warren Buffett's lost it argument, or on the other side of it, Warren Buffett's the greatest of all time. In this video, I want to focus more on the underlying businesses in the S&P 500 versus in Berkshire Hathaway, and what that kind of means for potentially the returns moving forward. But before we get into that, we do have a giveaway to do. So if you've watched my last upload on the channel, you know that we just hit 30,000 subscribers, and as part of that, I'm giving away a copy of, back here, Poor Charlie's Almanack. So in my screen, hopefully you're seeing that here, and we're going to do a bit of a random YouTube comment picker. So I've already got the URL in there. Let's filter out any duplicate users just in case anyone left like 50 comments to try and up their chances. We'll include replies. I think there were a couple of entries on replies to my pinned comment. What else? We don't want to filter out anyone. We're not going to blacklist or exclude anyone or add any extras. So we will get YouTube comments. I think there was like 300 entries in this, so appreciate everyone who entered the competition. People clearly like free stuff, and particularly Poor Charlie's Almanack. So 346 unique comments, and I think if I hit start, we should get a winner. Alright, and the winner is Gobi Nedan Chislian. Apologies if I've just completely butchered that name, but congratulations. Gobi is from the USA, and favorite manga quote was, "Acknowledging what you don't know is the dawning of wisdom." I like it very much. So congratulations, you've won the copy of Poor Charlie's Almanack. Flick me an email. I will leave that down in the description below. Flick me an email with your details and I will get that book shipped over to you. It's kind of funny having the book come from Amazon to New Zealand, and now I'll send it back to the US, but that is all good. So congratulations. Let's now get into the video on Berkshire versus the S&P 500. Okay, so in this video on Berkshire Hathaway versus the S&P 500 and my thoughts on kind of performance moving forward, I want to cover a few different things. So I firstly want to look at the historic performance of Berkshire versus the S&P 500. I want to look at the underlying quality of the business, and I also want to look at valuation, because myself as an individual investor, when I'm looking to pick individual companies, those are really some of the things I'm looking at. Not necessarily past performance versus an index or anything, but definitely past performance of the underlying business, and also what I expect future performance might be for that underlying business, and then the price that we're paying, so I can get a good feel on what kind of return I think I can get out of a particular business over time. So exact same process for Berkshire versus the index, and I should say that this isn't like a recommendation to buy Berkshire or buy the index. This is just kind of my thoughts on the whole discussion, and definitely do your own work on the topic if you're interested in making some sort of investment in either of these two vehicles. So in terms of historic performance versus the index, if we look on the first page of Warren Buffett's annual letter that he puts out every single year, we basically see this annual performance of Berkshire versus the S&P 500 with dividends reinvested, and we also see sort of a summary of both the cumulative and average sort of annual compounded return throughout the life of Berkshire Hathaway, at least with its current management in place. Berkshire was around before, obviously Buffett took it over, but from the period that Buffett has been at the helm, Berkshire has had massive outperformance versus the S&P 500. But in more recent years, Berkshire and Warren Buffett have started to cop a little bit more flack around their performance against the index. If we look at a very, very long-term chart, I'll put up a chart here that shows the rolling 10-year average of Berkshire versus the S&P 500, and you'll see that for an extremely long time, Berkshire was massively outperforming the index. But in more recent years, that gap has closed, and if we look over the past decade, Berkshire is actually just a fraction behind the S&P 500. And I would argue that Berkshire's underperformance in more recent years isn't necessarily a result of bad returns coming out of Berkshire. Again, I'll put the stock chart on the screen here so you can see how it has performed. I would argue that rather it's quite spectacular performance actually of the index. I think both have done well, and both have certainly given satisfactory returns by historical standards of the stock market. It's just that the index has done so extremely well that Berkshire really has struggled to keep up. But forgetting some of the history on underperformance and outperformance and so on, what does the current situation look like, and what do I think the prospects look like moving forward? Well, I basically want to take a bit of a Joel Greenblatt style approach to this discussion, actually. If you've read Joel Greenblatt's The Little Book That Still Beats the Market on his quantitative investing and magic formula style approach to investing, you'll know that the magic formula has had good outperformance of the underlying stock market over the long term. Doesn't work every single year, but if you're a long-term owner of this basket of magic formula businesses, which changes a little bit year to year, then you've had very good performance over the long term. And basically the two things that go into that magic formula, one is the return on capital, which is sort of a proxy for business quality as Joel Greenblatt uses it. And secondly, you have a valuation component as well. And the magic formula basically goes through the entire world of publicly available stocks to invest in and ranks every stock on both of those metrics. And it's trying to search for companies that have an unusual combination of a high return on capital, high quality business, and that are trading at a cheap valuation as well. And it makes perfect sense that a strategy like the magic formula has worked well over time if you're buying above average businesses for below average prices, as Joel Greenblatt describes it. It's pretty hard not to get a good result over a long period of time. And that's exactly what I want to do in this video. I basically want to look at Berkshire and understand the return on invested capital or return on equity as sort of proxies for business quality, as well as the valuation for Berkshire. And I want to compare that against the underlying businesses in the S&P 500, look at the valuation on those companies currently, and also look at the underlying business quality. So firstly, let's start with Berkshire Hathaway. Now, there was actually an accounting rule change back in 2018 that has made some of the accounts and return metrics for Berkshire much more difficult to use. They actually made a change in 2018 where essentially the quarterly fluctuations of the stock portfolio had to run through the income statement for Berkshire. So basically any time that the stock market went up, the earnings would look ridiculously good, and anytime the stock market went down, the earnings would look ridiculously bad. So if you're ever looking at long-term sort of charts on earnings or something, or return on invested capital for Berkshire, it is actually really hard to kind of use more recent years. You'll see in 2018 that data suddenly gets very, very lumpy. So I'm going to use something that is a little bit, I guess, smoother, and we're focusing on return on capital and return on equity anyway, and I'm basically just going to look at the underlying book value growth for Berkshire, because things like PE ratios and so on really don't make sense if earnings are extremely lumpy quarter to quarter and even year to year. And that ties nicely into the sort of Joel Greenblatt approach anyhow of using return on invested capital to try and figure out business quality. So I've pulled a line from the balance sheet off ticker called total common equity, and I'm basically going to look at the growth of that equity over time. So if I look over a relatively long time period, I've taken 16 years, which is as far back as I'm able to go in ticker. The compounded growth rate in equity for the underlying business of Berkshire Hathaway is 11% per year. And that's actually quite a useful tool. Some of the maths on Berkshire is a little actually more simple than other companies because they retain all their earnings. They're not paying out some of that equity as sort of cash dividends or anything, but that's going to be useful when we get into some valuation stuff shortly. So over the past 16 years, like I say, that return on equity or the book value has grown at about 11% per year. Over the past 5 years, it's grown actually just a fraction faster at about 12% per year. Now, if we then compare that to the S&P 500, this data I've got is up until about August 2020, so we're about a year behind, but this should give you a good feel for the sort of historic return on invested capital for the S&P 500. And you'll see from this chart here that has fluctuated from as low as about 6 or 7%, which it got down to in the financial crisis of 08-09, and it's been as high as about 9.5%, maybe just kind of sneaking up to 10%, actually pre-financial crisis. So on average, just looking at this chart, it looks like that return on invested capital has fluctuated anywhere from say 7 to 9% in a typical year. In terms of a return on invested capital, which is the first metric, Berkshire Hathaway does beat the S&P 500 a little bit on that metric, but of course we also have to factor in valuation and see whether you're paying a premium for Berkshire versus the S&P 500, or ideally, if you're a value investor, hopefully you can find one of these opportunities that is quite the opposite. Hopefully Berkshire is both higher quality and cheaper, which if any of you have been studying for Berkshire for a period of time, you may already know the answer to this, but let's get into that part of the discussion so I can give you my thoughts on the topic. Okay, so firstly, let's talk about valuation for Berkshire Hathaway. In their magic formula from Joel Greenblatt, he used an earnings yield, which is basically just a inverted PE ratio. So if you have a PE ratio of 10, for example, you invert that and get 1 over 10, which is a 10% earnings yield. So like I mentioned earlier, the earnings are very, very volatile for Berkshire now, just from their stock portfolio. So we'll have to do a little bit of work to kind of normalize those earnings and get a true feel for what the current earnings yield of Berkshire Hathaway actually is. Now, luckily for me, there is a man by the name of Christopher Bloomstran, who has been a very long time investor in Berkshire Hathaway and writes very extensive letters on Berkshire as well as some of his other stock holdings. And he has actually thought through the topic of sort of normalized earnings for Berkshire and what the future of the business looks like in a massive amount of detail, and he's written about it extensively. So I'm going to basically walk you through some of the logic from Chris Bloomstran in terms of how he thinks about valuation, in terms of how he thinks about normalizing some of these earnings yields to get a feel for where things do actually sit currently. So using that sort of framework that Chris Bloomstran has laid out, and I'll leave some of his letters linked down in the description below if you're interested as well, the first thing we will have to look at is actually the return on equity. And we'll be a little bit conservative here because that's exactly what Chris Bloomstran has done. And he's dialed his return on equity moving forward to down to around 10%. He thinks that the sheer size of Berkshire is a factor, which we'll get to shortly, but he thinks they should still be able to achieve about 10% return on equity moving forward. Now, if Berkshire had 10% return on equity and it was currently trading at 1 times its book value, that would actually mean that it was trading at about 10 times earnings as well, or normalized earnings, because again, earnings are very volatile. So Berkshire is actually currently trading at a premium to book value. It's trading at about 1.3 times book. So if we take that 10 times earnings that I just mentioned, if it was trading at 1 times book, multiply that by 1.3, we get to about 13 times normalized earnings. That's the approximate sort of normalized earnings type P ratio for Berkshire right now. Now, if any of you have been paying attention to sort of broader market valuations for the S&P 500, you'll know that the story for the S&P 500 is very different in terms of valuation. Luckily for me, the data here is pretty easy to access, so I'll put a chart up on the screen here showing you the current valuation of the S&P 500, and that is coming in at about 34 times earnings. So on this sort of simple Joel Greenblatt type analysis where we focus on the quality of the business and also the price, Berkshire actually has a higher quality business, or better returns on invested capital and better returns on equity, as well as a lower valuation compared to the S&P 500, which actually has a higher valuation, so it's more expensive, and it also has lower business quality in aggregate. Of course, mixed into the S&P 500, you've got the Facebooks and the Googles and the Amazons of the world, which are spectacular businesses, but in aggregate, that is what these results are telling us. And that is my view basically on this whole topic of Berkshire versus the S&P 500. I think it's hardly a certainty that Berkshire will do better than the S&P 500. You can never be certain of these things, but if I had to put my money in one of these things, and if I had to pick one of them on, say, a 5 or 10 year bet moving forward, my money would be in Berkshire at current prices. But please don't take that as a recommendation or investment advice or anything like that. It's purely just my thoughts on the matter, and there certainly are other considerations. We also have to focus on management, which in an S&P 500 context is going to be impossible to do. You're not going to be able to probably study 500 CEOs and CFOs and COOs and all that sort of stuff, and boards of directors to try and get a feel for management at each of the 500 companies. But I would certainly argue that the capital allocation and the management team at Berkshire Berkshire Hathaway is almost impossible to beat. So I think that makes kind of that analysis really simple. The big question for me is, what does the growth look like moving forward for Berkshire Hathaway? I think we've seen already that they've just gotten so large that they really are starting to struggle to allocate capital, the cash that's constantly coming in from their businesses. They do want to put it to work in either buying public companies or buying private companies to acquire entirely. But at recent prices, Berkshire has been pretty quiet in terms of making new acquisitions. So that's it from me for this one. I'd also be interested to hear your thoughts on this whole discussion down in the comments below. It is, like I say, a constant point of discussion across many investors, and that's kind of my 2 cents on the whole thing. So I do hope you enjoyed the video. If you did, please hit like and hit subscribe, and I will see you in the next one. Cheers.